In this video, we'll explore the different types of bonds available in the financial market. As we have discussed previously, a bond is essentially a loan divided into smaller securities, but not all loans are structured the same way. By tweaking the basic features of a loan, we can create very different types of investment instruments that suit different needs for both the borrower and the lender. Let us start by looking at the basic anatomy of a loan to understand how these variations work. Every standard loan or bond has three core pillars. First, there is the principal, which is the actual loan amount being borrowed. Second, there is the coupon, which is the interest rate paid to the lender. And third, there is the maturity, which is the time period after which the loan must be repaid. By modifying these three features, we can construct various types of bonds. We also classify bonds based on who is issuing them and how creditworthy they are. Now, imagine a bond that does not pay you any interest at all during its life. This is called a zero coupon bond or simply a zero. You might ask, why would you buy a bond that pays no interest? The answer lies in the price. These bonds are issued at a discount, meaning you buy them for less than their face value. When the bond matures, the issuer pays you the full face value. Your return is the difference between the lower price you paid and the higher face value you receive at the end. While this sounds simple, remember that these bonds carry higher interest rate risk compared to regular bonds because you have to wait until the very end to realize your cash flow. Let us look at the different variants of these zero coupon bonds. When they are issued for a short period, which is less than 1 year, they are often called money market instruments. Common examples include treasury bills issued by the government, commercial papers issued by corporations, and certificates of deposits issued by banks. When they are issued for a long term, they are often called deep discount bonds. A classic example in India is the Kisan Vikas Patra. To give you a real world example, in October 2009, a company called ETHL Communications from the SR Group raised 4,280 crores using this method. They issued a zero coupon bond where, for instance, in Series 1, investors paid 85 rupees and 80 paise to get 100 rupees back in July 2011. This implied an interest rate of 9.15%. Moving on, let us talk about floating rate bonds. In a standard bond, your interest rate is fixed. But in a floating rate bond, the coupon rate changes periodically. It is linked to a benchmark like an inflation index or interbank rates. This means if interest rates in the economy go up, your coupon payment goes up too. This is great for investors when rates are rising because it protects them from price risk. Sometimes these bonds have limits. A cap is the maximum interest rate the issuer will pay, and a floor is the minimum rate you are guaranteed to receive. Next, we have a very interesting hybrid instrument called convertible bonds. Think of this as a metamorphosis. It starts its life as a debt instrument paying you interest, but it comes with an option to convert the debt into equity shares of the company later on. When you buy this bond, the terms are already set. You know the deadline for conversion, the ratio of how many shares you get for each bond, and the price at which those shares will be allotted. Sometimes this conversion is compulsory and sometimes it is optional for the investor. Let us analyze the impact of these convertible bonds. For the issuer, this is attractive because they can usually offer a lower interest rate since they are offering the sweetener of potential equity ownership. Also, when the bond converts to shares, they do not have to pay back the loan in cash. However, the downside is that it dilutes the ownership of existing shareholders. For you as an investor, it offers the best of both worlds. You get the safety of regular coupon income in the initial stages, perhaps when a project is just starting. Later, If the company does well, you get to participate in the growth through capital appreciation of the shares. Now, let us look at a more complex product called a Principal Protected Note or PPN. This product aims to give you the safety of debt with the high return potential of other assets. It works by splitting your investment. A large portion is put into safe debt to ensure that by the time the note matures, it grows back to your original principal amount. The remaining small portion is invested in high risk, high reward assets like equities or derivatives. It is crucial to understand that while your principal is protected from market fluctuations, it is not protected from credit risk. If the issuer themselves goes bankrupt, your money is still at risk. Another risk investors face is inflation, which eats away the value of money. To combat this, we have inflation protected securities. The Reserve Bank of India issues inflation indexed bonds where both the principal and the interest are adjusted for inflation using the wholesale price index. This ensures your real returns remain positive. There are also national saving securities for retail investors like the ones launched in 2013. These were linked to the consumer price index. They offered a fixed rate of 1.5% plus the inflation rate, ensuring that your savings grew faster than the rising cost of living. Companies also look outside their home country to raise money. These are called foreign currency bonds. For example, an Indian company might issue bonds in US dollars. The motivation is usually to access lower interest rates available in developed markets. A good example is when Delhi International Airport Limited issued dollar bonds in February 2020. However, this comes with a major risk called foreign currency risk. If the dollar becomes stronger against the rupee, the company will have to shell out more rupees to repay the loan, which can be very expensive. To solve this currency risk problem, we have something called external bonds, specifically Masala bonds. These are bonds issued outside India, but they are denominated in Indian rupees. The first Masala bond was issued in November 2014 on the London Stock Exchange. The key difference here is who bears the risk. With standard foreign currency bonds, the issuer takes the risk. With Masala bonds, the currency risk is shifted to the investor. If the rupee falls in value, the foreign investor gets less value in their own currency while the Indian issuer is safe. Finally, we have perpetual bonds. As the name suggests, these bonds do not have a maturity date. The issuer is not obligated to ever pay back the principal amount, but they must pay coupons forever. In India, banks often issue these as additional Tier 1 or AT1 bonds to meet Basel III norms. These are riskier than normal bonds. The bank can buy them back if they choose, but they are subordinate to other debts. Also, if the bank does not make a profit, they might not pay the coupon at all, and these missed payments do not accumulate. They are gone forever.